Good morning and welcome to today's webcast, Preparing for Your First 401k Plan Audit. Before we begin the presentation, I'm going to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning again, and thank you all for joining us. I'm happy to introduce today's presenters, Bertha Minnihan and Ryan Koch. Bertha has been in public accounting since 1995 and serves as the national practice leader for Moss Adams Employee Benefit Plan Audit Group. She has extensive experience directing all phases of audits for a variety of benefit plans, including 401k, 403b, pension, employee stock ownership, and health and welfare benefit plans. Ryan has been practicing public accounting since 2001, primarily serving employee benefit plans and venture funds. He specializes in all aspects of employee benefit plan audits, including 401k plans, pension plans, health and welfare plans, and SEC Form 11K filing requirements. Bertha, I will now turn the line over to you to get us started.
Thanks, Emily. Good morning, everyone. Thank you for being with us. This webinar is one of my favorites. So we're going to start with some learning objectives and what we hope you walk away with at the end of the hour with us. We're going to talk about what the requirements are for first-time audits and how you can better prepare yourself. That's really the main focus. As you know, fiduciaries, we want you to learn what to expect from first-time audits, how to perform your fiduciary duties so that you are, helping your employees out, and of course to share the common trouble areas around compliance and operational defects that we find, because since you haven't gone through an audit, I think that talking about what could go wrong will help you out and better prepare for your first audit. So we're going to start off the bat with a polling question. And remember, as a reminder, Emily mentioned you have to answer them to receive CPE. And this one's an easy one. We kind of like to see what areas our audience represents so we can better speak to all of you when we're talking about our examples and stuff like that. So I think the polling should be open now. We'll give maybe a minute and close it out. Let me see if I do this correctly. We can see.
There we go.
Oh, wow, good. We have a good representation of finance and some human resources, a combination, and plan administrative committee, which we'd love to see. Awesome. So now I will turn it over to Ryan, and you're all in for a treat. Ryan, have a
yes, you are. That
yes,
is
you
absolutely
are.
correct. So the first thing We'll talk about the requirements to start. And so, as you're probably aware, the small plans are not required to be audited by an independent accounting firm, but once you grow up to be a large, what the DOL calls a large plan, you are required to be, by law, under ERISA, to be audited by an independent accounting firm. So what is a large plan is the big question, and it's not as the magic number right here, as you'll see, is 100 eligible participants. That's kind of we'll go into what eligible means in a second here. The good news is for small plans that are growing up is that you do have a little bit of cushion between 100 and 120 eligible participants. It's 120, more than 120 eligible participants if you've never been audited before. That's the easy way to kind of break down that rule. So if you're coming up, you had 80 last year and you've got 115 this year, you still do not need an audit. It's only when you go over 120 for the first time. And then the other requirement, which always applies to a 401k plan by law, is that the assets have to be held in a trust. This is why most health plans are not required to be audited, is because they do not have assets held in a trust. But if you do have assets held in a trust for a health plan, you would need an audit. So they fall under the same rules.
And having said that, of course, we have seen the DOL ask for audits when someone goes over 100, but are less than 120. So it's always just good, if you're not sure, file the 5500 quickly. And then you'll definitely get your rejection notice and know.
Exactly, whether you need it or not. So let's talk about eligible participants for a second and what that even means. So obviously that would be all eligible active participants, people that are employed by the company today and could participate in the 401k plan today. That also includes terminated employees with account balances. Those are people that are still in the plan, still have a balance, still have accounts. And you get to add those two things up, and that's what you get at your eligible participants. So there are few things there's few problems that come out of this, that there's some misconceptions. When you start talking about eligible participants, people start thinking, well, is it only people who are actually participating? No, it's not. If you could participate, then you're considered an eligible participant for 401k purposes. And then it also includes those old balances that could be very old that are still sitting in the plan. So you add all those up, that goes over 120, you will need an audit for the first time. And the timing of when that needs to happen, let's talk a little bit about the financial reporting for a second before we get into what time periods we're talking about. So when you're a small plan, you file generally a 5500 short form. That's what the SF stands for there. And it is a whopping 2 pages of information. And a lot of the time, you don't even think about it. Your TPA or provider will just prepare it for you, send it over to you for a signature, digital signature, and it gets sent in. It's not even a big deal. When you grow up and become a large plan, though, that's what the 100 plus participants, that's what that's referring to. The filing can be much longer, including the audited financial statements that get attached. We're talking upwards of 40 pages of information now, which is obviously quite a step up from the 2 pages that you don't really need to worry about. Now you've got a bunch of attachments that potentially need to be added to the 5500. The financial information is much more robust. And then the audited financial statements, of course, which is the largest, I think, administrative task when you're going through this 5500 filing. So what can you expect from your audit? There's a couple things. I like to break this down into, when I'm a benefit plan auditor, I actually have to wear 2 hats. I've got my traditional bean counter auditor hat, which is the financial reporting aspect of the auditing. That's what I went to school for. That's what my CPA license generally allows me to do. The CPA exam and school doesn't really prepare you for 401k compliance auditing. No. But that is the other half of the audit when you're doing 401k audits or just benefit plan audits, is the compliance aspect of it. The DOL expectations, the IRS expectations of what they expect an auditor to be looking at when it comes to plan operations. So there's a financial statement that goes along with the audit. That's our final deliverable. It looks like very similar to a set of normal financial statements for a company. because it's, got an audit report attached, you've got a statement of net assets, you've got a statement of operations, and you've got notes that go along with it. And all the same GAAP applies that not all the same GAAP, but a lot of the same GAAP applies that would apply to a company. But you still got this compliance hat you got to wear. And we'll talk a little bit about what compliance errors we see a lot of the time when we're doing these types of audits to give you an idea of what we're looking at.
Right, and that's really important for the finance folks because they're kind of like, why are you looking at this? Why does this matter?
Right.
And sometimes, that feeds into everything we have to do. As a firm, our practice is, about 4 in the country, so we're really heavily regulated by the Department of Labor. And for the accountants on the call, the Department of Labor can't necessarily take our license away, but they can sure make our life hell. But the compliance things they have incorporated are really helpful to keep the participants safe and the plans running, smoothly. So the compliance side, again, is to keep in mind that there's a lot of stuff that we may not normally do in an audit, but we would do because the DOL wants us to look at certain areas.
That's absolutely right. So the first thing, as we go through the rest of these slides, I kind of broke down how to prepare into 5 different buckets. And that's kind of going to be the main, the meat of this presentation is going through these 5 buckets and what we mean by each one of them. So the first one is document gathering and organization. Then we have fiduciary responsibility. Operational compliance, that's when we're going to talk really about that compliance hat that we wear. Internal controls and financial reporting. The internal controls really kind of splits the difference between financial reporting and compliance because we talk about internal controls on both sides. What controls do you have over compliance, and then what do you have over financial reporting? And then also financial reporting, of course, we'll go over some unique aspects of kind of the benefit plan gap, if you will, although most of what we're talking about relates to investments when we talk about financial reporting. So first bucket is document gathering and organization. And this seems pretty simple. I mean, obviously you're going to have some documents that relate to your plan, and you're going to want to obviously have those on hand when you have an audit. I would say whether you have an audit or not, you probably should have these on hand and very well organized. I can't tell you how many times I've gone to a first-time audit and start asking for very basic plan documents, for better terms, for lack of a better term, even though the plan document is an official thing. And we ask for things like an executed plan document, and we get a summary plan description. Here's your plan document. No, this is not the same thing. Okay, well, let me see what I can get. Oh, here's a Word document of a plan document that seems to be unsigned. Yeah. That's also not good. So things like that we'll go through each one of these a little, briefly, but, an executed plan document, this is your legal actual form of the plan, and it should be executed. I know the DOL has dropped the hammer on auditors for not getting copies of executed plan documents, and also dropped the hammer on employers that do not retain an executed plan document, or maybe they didn't even sign the plan document in the first place. Yeah.
And again, these lists are our cheat sheets. Like Ryan is saying when the DOL is coming. I mean, there's literally nothing out of our playbook that's not taken from what the DOL looks at, because, we're not only protecting you from us, which is your first line of defense, first line of auditors. We want the DOL to come in and look at this and not find anything missing. So it's literally from their list as well. So if they come and audit you, even before you need an external audit, this is what they'll look for. So that's why, like Ryan mentioned, it's great to spend a few hours. And again, it's not an exorbitant amount of time to kind of gather this, put it in a binder, folder, whatever, share files on your network.
Exactly. I was going to say we are living in the 21st century. Yeah. Having a file cabinet full of these documents is kind of, old hat, but having, a network drive for the fiduciaries of the plan where they can always get at the executed plan document. And we go down the list here. The determination or opinion letter. I think determination letters are going to be less and less common. They've been less and less common over the last few years. Don't need to get too much into that. Determination letter is a letter from the IRS saying that your plan, this company's exact plan, this plan document is a tax qualified plan. Right. An opinion letter is a letter that says that if you have a prototype plan with like a Fidelity or Vanguard, or most of the providers now write their own kind of check the box type prototype plan documents. The opinion letter is the IRS saying that the way that this plan is laid out with the check boxes and all that kind of thing is most likely is a tax-qualified plan if you don't do anything silly when you're designing the plan and check the wrong boxes and that kind of thing. So you definitely want to have one of those on file. If you have a prototype plan, which most plans do, especially small plans, that would be but with the prototype plan generally. You're not going to need to get an extra copy of that. Obviously, if you have any amendments, you're going to want to keep those on file, executed versions. Summary plan descriptions and then summary and material modifications kept up to date, and keep those around. Those are probably easier to get your hands on because you're going to be giving those out to your new employees, and whenever you change things, you're going to give them out during open enrollment, and those sometimes open enrollment, sometimes orientation, those kinds of things.
Yeah, and a good question's come up on the timing of all this, right? On the first-time audit.
Yeah.
And of course, the items we're gathering, like what year do they relate to, and all that. So, I think we had a slide. I don't know if we skipped over.
I'm going to push that back. We're going to go backwards for a second.
Do we have that? Yeah, because we are going to cover the timing of when you're calculating if you need an audit, and then once you do, that Ryan's going to cover. Let's say you need an audit for the 2016 plan year. These are the documents that apply to that plan year. So that was a great clarifying question. Ryan's going to go through when you need an audit, but again, if you need an audit for the plan year, because again, the plan is what's being audited, it's a legal entity. If the plan needs an audit for a certain plan year, we're asking for these documents that apply to that plan year.
Yes. So I'm sorry I skipped this slide earlier. I will go through. I know it's kind of disjointed, but it is what it is. It is because the question came up. I think it's important to go back and kind of understand this. So when we talk about the participant count and what drives you over that audit requirement, it's at the beginning of the plan year that we're talking, because that's a misconception. A lot of TPAs will say, you'll call up your TPA and you say, hey, we just added our 121st employee or something like that. I think we're over the limit. And it's the middle of 2017 right now. And they say, well, that's exciting. You're going to need an audit.
Yeah.
Well, and then we got to get a lot of calls saying, well, my TPA just told me we're going to need an audit. We just went over it. It's March 21st, 2017. We just went over 121 participants. We're going to need an audit this year. And it's like, well, no, you're not. Yeah. Because it's actually at the beginning of the plan year. So at the beginning of 2017, you had less than 121. Well, you had 120 or less. And only in 2017, you added that 121st employee. So now, or eligible participant. So now, when you get to the end of 2017, the beginning of the 2018 plan year, that's when your audit period is going to start. It's at the beginning of that period.
Yeah.
So now you're going to have the whole 2018 plan year go through, and then you're going to get the audit of that period in 2019. So if you're going over right now, you've got almost 2 years before your audit is going to actually happen.
So for the folks on the call, you really want to grab your 2015 tax return and see what you ended up with at the end of 2015, and then see if you have any, abnormal eligibility requirements. Let's say if you have a quarterly entry date and at 1/1/16 you had a bunch of people coming. Does that put you over the 100? So that's key. It's as of the beginning of the plan year.
Right. So then we go to the audit period. So now let's just say we had we actually know that we have to get 2016 audited. So we've got the year happening here at 1/1/16, this normal calendar year for your plan. 12/31/16, that's your plan year. And then you've got 7 months to get your audit done between 12/31/16 and 7/31/2017. And then on top of that, you can get a 2.5 month extension all the way out to October 15th of 2017. So you've got a very, very long time to get these things done. I would say 75-80% of our clients take the extension. It's not bad. I've heard a lot of arguments, clients saying, no, I have to make the 7/31 because it looks bad if I file an extension. It does not. Everybody does it.
And then I'm laughing because we have the years where everybody does it.
Yeah, exactly.
And it's comical when we look at our stats and we're issuing, 80% of our audits in like the last 2 weeks. So please, for your auditors, don't wait till the end. But
All right. So we're going to go back to the documents, but that's a good question. I'm glad we got that. I had a feeling we had skipped that slide. And
then the documents. So again, we're looking for 2016 plan year. If you had changes during the year, again, you're going to need all the documents that apply to that year.
Right. So other things we're going to ask about: executed 401k administrative committee minutes or board minutes that apply to the plan. Generally, there's not a lot of board minutes that apply to the plan. Sometimes authorization of a plan in the first place if it started during the year, or authorization of the committee itself, delegating the authority to run the plan to the committee. Those are the two ones we generally want to see out of the board. Also, if a plan gets terminated, but we're not talking about that. Those are the three kind of red flags that I would think that a board would talk about the plan for. And we'll talk a little bit more about the committee. So here's your kind of summary of what we're going to be looking for, the 6 big items, and then there's a few other things that are a little bit less important that we'll talk that you should have on hand. But for the audit, they don't really kind of put up any red flags. The trust and record keeping agreements, we're going to ask for that. They give us some good information, and you should definitely have those on hand. Past Form 5500s. If you don't have these, they're very easy to get a hold of because they're available online at efas.dol.gov. If you've filed them over the last few years, you can get your hands on any 5500 filing for any company. They are public information. Go ahead.
The agreements are also really important. This is another thing. We come in and you make these huge agreements. Ryan's referred to the TPA. That's your third-party administrator. You have your custodian. There's so many agreements, and often there's no signed copy.
Absolutely. That is true.
And, the DOL changed this a few years ago because they really want to know that fiduciarily you're taking care of your plan and you're getting the best providers in play. So please keep all those records. When the plan enters into a contract, keep that contract.
One of the things I'll say about the contract is I can't count how many times we've asked for, do you have any amendments to your plan document? Like, did you change your plan at all? And did you have an amendment for it? And then I get amendments to their service agreement as the amendments to the plan document. And they're similar. You've amended, parts of your plan, probably like the way you process distributions or something like that with your record keeper. But I think it's kind of important to know the difference between like what's in your plan document and what's in your service agreement, and how those affect each other. So that's something to just be aware of.
So we have another great question. We have a couple. One is about where you find the website for the 5500. I'm going to find that for you, Ryan, and I'll give that in a minute of where you can look up 5500s. But the other good question is we have someone who has a plan that started 10/1/16. They were over 100, but the plan started in 10/1/16. So another good question on an exemption.
I got good news for you.
Yeah. Listen.
If you have a short plan year that's less than, I believe, 7 months, then you can wait, and it's the first time this plan's ever been audited, and it's just came into existence.
Yeah. 6 months. Yeah. But go ahead.
Then you can waive your first period audit and you get basically a 2-period audit next year.
So you defer the 3 months or the 6 months. Right. And it only applies if it's a change in your end, a new plan. These are the extenuating circumstances where you can defer that audit to the next time period.
Right. So in this particular circumstance, you've got a 3-month period, which you would defer this year, so you don't need your audit this summer. You would get an auditor for next summer, and then they would do an audit of the 3-month period and the year ended 2017, and they would issue hopefully one report that gets attached to just the one 5500 for 2017.
And you still file a 5500 for the 3 months of 16, and there's a box on Schedule H that you are telling the DOL you're deferring your audit.
Right.
So very good question. And that helps when you guys are changing your ends and stuff. Sometimes clients change and they change in April. And I'm like, if you only changed in mid-July, you could have, you could defer things. So be aware of that. It's new plan. It's a few things, but mainly those couple things. So great question. And I'm going to look up the website. You can do
Sure.
That. Yeah. Thank you.
Okay. I think we're going to move on from the document gathering. The last one here is just fidelity bond insurance. I do want to say that there's probably 2 major pieces of insurance that you're going to want for your plan. One is required by law. The other one is just a really good idea. The first one, the one that's required by law, is the fidelity bond insurance. That's the one that protects the plan assets against theft so if your employees start stealing money out of the trust of the plan, this fidelity bond will make the plan whole. This is required by law to have under ERISA. The one that is not required by law, but everybody has it, is fiduciary liability insurance, and that's the one that protects the fiduciaries if the plan gets sued or the fiduciaries get sued for not treating the plan in the best fiduciary interest, and they lose. That insurance would cover the fiduciaries from having to pay out under that sort of thing. And I'm not an insurance agent. I'm not a lawyer either. That's my general understanding about those two things. I'm sure I've said some legally inaccurate things when it comes to those things, but generally what you need to remember is fidelity bond covers the plan from theft, is required by law. Fiduciary liability insurance covers the fiduciaries from suit and is not required, but is a really good idea.
And these documents, one other question has come up, how far back should we go to keep them? Because the auditor's looking for the year that it applies and, of course, the future if there are amendments.
So I would generally say, yeah, well, she's holding up 7 years. I'm having a different issue right now. So, yeah, 7 years is a really good idea. I would say after, so say you amend your plan document, amend it, restate it, you want to keep your old plan document for at least 7 years. There are certain things that you want to keep for even longer than that. But I think 7 years is a pretty good, pretty safe standard there. I am disconnected and I am having trouble right now. So can you push to the next thing?
Sure.
Oh, no, I got it.
You got it?
There we go. I did it. So after going through all those documents, do you have them all right now? No, and I'm not even sure what many of these are, but I just explained it. You should know that. Okay. No, and then maybe, and I think I know where to find them. Then yes, we're already prepared. I have a digital file cabinet that's super organized, and I know everything. Or I'm not sure because this isn't my job, or something else like that. So I'll give you a second to do the poll.
I have the website that after this we can just mention.
Okay. We're going to move on. Maybe is the overwhelming response, which is a good,
honest answer.
Somebody said no, which is good.
Yeah.
So before we move on to the next thing, the website is to find.
Yeah, thank you. And I have people that are helping me, which is awesome. So it's EFAST, EFAST.dol.gov. And I'm going to stop there because there's some stuff that happens. But when you go there to the left, top left, you're going to see 5500 search. That's what you want. So again, EFAST.dol.gov, and you're going to get to top left, which says 5500 search. And several folks found it for me. Thank you. And if you can't, please email us. Thank you.
Okay. So let's talk about fiduciary responsibility. So one of the things that has been quote unquote fun for me over the last year is that I've actually become a fiduciary of the Moss Adams plan over the last year or so. So I sit on our plans committee. I help review the investments. I look at plan operations. We select the vendors, yada, 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 all those things. So one of the first things I have to ask myself is, what is a fiduciary? The legal definition is that if you exercise any discretionary authority over control over plan management or plan assets, or you can render investment advice for a fee. So if you're bringing on an investment advisor that you're paying to give you investment advice for the plan, they are also fiduciary. They will generally take fiduciary responsibility gladly for the plan. And then if you have any discretionary authority or responsibility over plan administration, so that's more day-to-day things. If you can discretionary make a decision about day-to-day operations, that would make you a fiduciary as well. So it's a very broad kind of definition of what a fiduciary is. So the next poll question is dovetails right into that. So what best describes your 401k committee? Hopefully you have a committee. If not, we're going to find out in this poll about who are the fiduciaries. Do you have a committee of fiduciaries that kind of administer the plan? So you've formed a committee, you've met a couple times, maybe took notes, maybe not. We've formed a committee, met a couple times, and sometimes take minutes. So I guess option 1 says no minutes. Option 2 is we sometimes take minutes. We formed a committee, meet regularly, and always take and retain minutes. That's great. And then the other one is we're totally forming a committee tomorrow because we've just heard this thing and we should do it. So we're going to wait 5 seconds exactly to finish the poll.
Yeah, wait a little longer. I think people, to make sure someone was saying like they had to start over.
1, and we're moving on.
And then I have a question to cover, which I'm trying to answer, but I don't know if my answer's going through, so I'll have you. Are you seeing?
My poll results are going slow. There we go. So we've got, about 35% of our, 37% of our people have a committee, and they're meeting sometimes, and sometimes taking minutes, sometimes most of the time not. We've got 38%, about a third, that are really good, and we got about a quarter that are going to do it very soon.
Yeah, and for the ones that sometimes take minutes, please do.
Yeah, absolutely.
We're going to talk about that, yeah.
Absolutely.
But on the fidelity bond, what's the amount? You want to just cover it?
Yeah, so the amount, it's a math problem. The quick answer is $500,000. The official answer is no less than 10% of your assets in your plan. So if you have $4 million, you only technically need $400,000 of fidelity bond insurance. But generally, the safest way is just to get the $500,000 because the cap's out at $500,000. That's the maximum that you ever need, unless you have employer securities in your plan, which most plans do not have. So if you're working for XYZ Corp and you've got XYZ Corp common stock as an investment option, then you need $1 million. That caps out at $1 million. So that's the quick answer: $500,000.
Perfect.
So what should a fiduciary do? Now that we know, so let's talk about the committee for a second, because I asked the question about, do you have a committee? And some companies do, some companies don't, some take minutes, some don't. So what should you all do? Best practice, there's no requirement that you have a 401k administrative committee. There really isn't. But best practice throughout the industry, absolutely, without question, is that you should form an administrative committee. And the committee should be made up of representative people in the company and finance and plan management, probably human resources or benefits, basically so you get a slice from all different angles of plan administration. So plan administration and fiduciary coverage. So for our plan, I am almost none of those things, actually, if you think about it. I'm not an investment expert, other than I see them a lot in these plans, but I don't know good performance from bad performance. I'm learning a lot as I go along. And we have somebody that does that sort of thing. We have somebody from our wealth management arm that is on our committee that can do that sort of thing. We also have an outside investment advisor that helps out with that sort of thing. We have a human resource, our VP of human resources is on the committee. We have, and why am I on it? Because I do a lot of audits and I bring an operational compliance aspect to the committee. Mm-hmm. So we have kind of a different cross section of different people that have something to say about the administration of the plan and fiduciary responsibilities, so that we all are kind of bringing our aspect to the table. Does that kind of make sense? Yeah.
Oh, absolutely. Yeah. So because, no one's born, I'm a perfect committee member. Right. And no one's going to be born knowing this stuff, but it's the people that actually want to come, want to serve the employees, want to get to know things, have a good also representation, right, of the employees. If you have we have a lot of clients that are retail. And so, for the retail industry, let's say if you have no one from marketing, let's say on your committee, marketing is huge, right? I mean, so are you leaving out a demographics in your plan that may need representation or have some needs through the plan that aren't being met through the committee? Right. So you also want to make sure you cover that cross-section, not just pick the highest people with titles. Right. That's not really
CEO, CFO, COO.
Exactly.
That's it, right?
Yeah, exactly. VP of this and that, when, VP of, whatever is like a small group of 100 people, and you're forgetting a whole, demographic. Right. So.
No, on the other hand, you definitely probably want to have somebody like a CFO sitting on the committee, because they have a, if you're saying, well, let's give 100% match with no limit to everybody in the company. CFO is probably going to say, that's probably not a great idea financially. So
and then there's a lot of education, right? So to your point, like the CFO might know a lot about the finance side. There's a lot of education available for committees. Yes. So don't be afraid, because what I hear is I ask so many people and they go, we don't know anything about ERISA. You don't need to know anything about ERISA. You actually just have to be the prudent. This is like your money that you're handling. Mm-hmm. Do the right thing and educate yourself. And again, it's not a life sentence. Right, there's terms, which is good. So it's not like, except Brian's going to be on our committee until he retires, but no.
So that's the form part of it. Who should be on it? Hold regular meetings of the committee. Quarterly is best practice. You can do it less. You can do it more. More is a lot.
Yeah. Well, let's say you're having a change in provider.
Yeah.
You might be meeting every other month,
yeah.
right? Yeah.
So you want to also any meetings you have, you want to take and retain meetings of those meetings, minutes of those meetings.
That's huge.
That is, if you don't have minutes of your meeting, it's like you didn't have one at all.
Yeah.
And that's the burden of proof to if you're in court and you are getting sued by your participants because you didn't do a good job administrating your plan or choosing investments or monitoring investments or monitoring fees and all those kinds of things, the first thing that somebody's going to ask you is, did your committee meet? You're going to say, yes, we met on October 12th, 2016. Cool. Okay, great. What did you talk about? We talked about this. Well, were there any minutes taken? No. Okay, well, then how can we really assume that this actually happened?
Because, again, the end result isn't important. Yeah. We always reiterate this because the DOL does. Let's say you picked the wrong provider. You picked the wrong investment. Participants lost money. That's sometimes not as great as you proving how you got to that decision.
Right.
Because maybe you made a prudent decision based on the information you had to keep a fund online, let's say. But participants lost money. The DOL and any attorney will look at that process and go, wow, you really did fiduciary. Your fiduciary duty. But if you don't have that track record, you cannot show it.
And one of the ways to actually keep a track record when it comes to selecting investments and monitoring investments is to develop and follow an investment policy, which is kind of a roadmap of what kind of investments and what kind of lineup you want to have in your plan that would satisfy your fiduciary responsibility. And then you monitor your investments according to the investment policy. And if it comes out of policy, you would replace it, or you would come up with a reason that you don't replace it. You document all that, and that's going to help you make prudent decisions without just having arbitrary kind of guidelines about when we're going to kick out an investment, when we're going to add a different one, that kind of thing.
When we're going to add a new provider because they're my golf buddy. That's our favorite.
Well, the other one is, you've got some, and we get this a lot, we've got engineers who think that they should be day trading in their 401k plan. So they say, we need a brokerage account, and I need a gold ETF as an option in this thing, and I need all these things. Why don't we have, an international emerging markets value fund? Because I really want to have that so I can really invest in that in my 401k. Now, a lot of committees say, well, the guy wanted it. Of course we should have it, that kind of thing. But it's not up to them to decide what investments to have. It's up to you. So you've got to figure out what's best for all your participants.
Exactly.
And if participants want to day trade, that's cool. Take your savings money outside the plan and go day trade to your
at a small brokerage while you're balancing it with the other investment lineup. But we've seen everybody put in one way or the other. Like Ryan's saying, you're kind of like the dad or the mom representing all the kids.
Absolutely. I mentioned this a little bit before. You're going to want to review administrative fees being charged to the plan for reasonableness. I am an auditor. We do charge a fee. That is one of the fees that should be reviewed for reasonableness, but is a actually relatively small fee that should be reviewed for reasonableness. The biggest ones being your record keeper and investment fees, and they are a lot of the time they are hidden, and you're going to need somebody to kind of help you out actually deciphering even what's in there. So I would say consider employing the services of an outside investment advisor who will help you navigate things like putting together an investment policy. They'll help you figure out what you're actually paying in fees and how you can get a better deal and that sort of thing. They'll take the minutes a lot of the time of the meetings. They'll keep you honest about having meetings. They are really kind of your guide to having a good fiduciary responsibility in your plan. And I can't recommend having one enough. We have one. And most plans, it's kind of the trend at this point. All right.
We're going to talk about some things that we see go wrong.
So third bucket, and we're definitely not going to spend as much because I think the two biggest ones were the first two ones.
Yeah.
We're going to start talking about operational compliance. Are you seeing the slides load up?
Yeah.
Okay, you are. Okay, so I'm just going to go off of it. So
yeah.
The first one is it timeliness deposits? I'm not loading up very quickly here.
The first one's eligibility.
Okay, so eligibility requirements. So the first, thank you. So eligibility requirements are a tricky thing, and it's actually it's the number one issue that I see with plans that are being audited for the first time. This is your plan document requires that certain people be let into the plan and certain people be excluded from the plan, and sometimes actual practice does not line up with what the plan document says. So here's a great example that I see all the time. We have an HR person, well, not we, but just in this company we're auditing, has an HR person that is not allowing any interns or part-timers or anyone who's not eligible for health benefits to participate in the 401k plan. The logic being that if you're not eligible for health benefits, then you're not eligible for any benefits and therefore are not allowed in the 401k plan. I mean, it tracks, kind of in a logic way. But if I go and check their plan document, a lot of the times it says no exclusions, which means that if you're an employee of the company in any way and are getting paid through a normal payroll cycle or not leased or anything like that, then you should be eligible to participate in the 401k plan. And I see that a lot, where interns and part-timers and temporary employees are not being allowed to participate in the plan, and they should have been.
Yeah.
And that's, go ahead.
So one of the main things is the plan document rules.
Right.
You've never been through an audit. One of the biggest things, as we're covering operational defects, we're going to constantly say the plan document rules. So we get a lot of questions. I've never had an audit. What should I do? And our first answer is, what does your plan document say you should do when it comes to any provision? Right.
And that's kind of the next one is a very similar problem, which a little bit less exciting about rather than am I allowed to participate in the plan or not, but it's about what compensation deferral should be calculated on or not. And so your plan document has a definition of compensation, which generally has some pretty ugly IRS codes in there that people don't generally understand all that well. But the one that people understand really well is W-2 compensation, which is a very common definition of compensation in your plan document. Now, if what you're actually withholding on through the payroll system is different than what's in your plan document about what you should be withholding on, then we got another problem.
Right.
And so that's something that we look at as auditors as well. Here's an example of an issue that comes up, and I'm from the Bay Area. I know a lot of people aren't, but we issue a lot of stock options in the Bay Area. And this is one that comes up as kind of a questionable one, where stock option compensation for exercises is W-2 compensation. But there's no cash that actually goes out the door when you exercise the stock option. And sometimes non-qualified stock options get taxed or show up in W-2 comp before you even exercise them. They're just at issuance. So, or RSU, restricted stock units, or just stock compensation in general can get really tricky.
And then my favorite is fringe, right? Everything's called fringe.
Oh, yeah.
But fringe benefits are excluded. But then they're deferring on, but it's W-2 income. So you got to make sure you understand your codes. Don't overcomplicate your payroll codes.
Right.
If you're throwing everything in fringe, then make all of fringe, eligible or not. Just make it simple so you can administer.
Right. Those ones, the fringe stuff is a little bit easier because we're not talking big dollars here, right? Like if you give them a $25 a month gym membership fringe benefit or something like that, that shows up on your W-2, and you might not withhold on it. But we're talking about a fraction of a fraction at that level. But sometimes these stock option things, we just gave restricted stock units to an officer of the company for $2.6 million or something like that. Yeah. Great, and we withheld no 401k on that, even though we should have, based on your plan document of just W-2, no exceptions. Yeah. You can always add exceptions. You can always have it just be all cash compensation on the W-2, which is much easier than that kind of thing. But the important thing is know what's in there and make sure your payroll system lines up with what's in there.
And we have nifty grids, shall we say that now?
Yeah.
Please, and when we've done this in the past, if you need a guide or you have, you want a sample, email me. We'd be happy to share with you how we track this. Nothing magical.
Okay.
You want to do your third one?
Yeah, the third one is timeliness of deferrals, deposits into a plan trust. So this is the one, you've probably heard of this one, and hopefully you have. This is always a rule. Whether you're a small plan, large plan, little plan, whatever kind of plan, there's always an expectation that if you're withholding money from participants' paychecks, that is not the company's money. That is a participant's money, and you have a responsibility to get rid of that money and put it where it's supposed to go as fast as possible. As a small plan, there's a safe harbor that if you take that deferral money and move it to the trust account within 7 business days, you're fine. That's as a small plan, though. As a large plan, the rule gets a lot more broad and harder to interpret. So it's the as soon as administratively feasible rule, which means basically that if you've demonstrated that you can get it in within 2 days, then that's the standard that you're going to be held to.
So now that you're becoming a big plan,
yes.
Some of you graduate,
yes, absolutely.
Stick your big boy and big girl pants on, that remember, if you're sending withholdings, after 2 weeks, that might not sound too good once you go through an audit.
Right.
So.
Especially if it's a mistake or this person,
exactly.
the vacation excuse comes up a lot around the end of the year. Everybody was gone for the holidays, so we didn't get in our December 31st payroll until January 10th or 15th.
Yeah.
That's not going to fly with the
John
DOL.
and Jane went on vacation. Nope, got to have backups, got to cross-train.
Exactly. But if you look at the last bullet point, if you have anything that's after the 15th business day of the close of the month following a pay date, that's always late. Always, always, always. Okay. But that doesn't make it the rule. I think that's where we get a lot of confusion. Even providers have confusion about this. I can't tell you how many times I've said, you've demonstrated that you did it within 1 day all year. And then one time you did it within 8 days. Or 8 on the 8th day. Well, that 8th day, if I'm the DOL, 100% that's late, and it should be corrected as it's late, based on what I've seen out of the DOL and the way that they call things late. But then they go to the provider, and the provider says, "What are you talking about? This is late. It's within the 15 business days." Do not listen to your provider.
No.
Listen to your auditor. People don't usually trust us about this sort of thing until it's too late. I've had a lot of clients that I've said these are late. They say, "Nope, we're not reporting them as late." Say, "Good luck to you." And the DOLs come in and said exactly what I told them and had them pay penalties and refile their 5500 and all that good stuff. So the only advice I can give you here is set a policy, follow the policy. If you go out of policy, correct it, and listen to your auditor. The auditors know what they're talking about when it comes to this kind of thing. So here we go. That's pretty much it on late deferrals.
Mm-hmm. So we have a few minutes. We want to cover some control, financial reporting.
Yeah, internal control. We got a few minutes. This is exactly where I want to be because I don't want to spend a lot of time with internal controls. The way that Moss Adams looks at internal controls, and everybody looks at it when it comes to 401k, is that most of the controls don't lay with the sponsor. They actually lay with your provider because they're doing 80% of the administration of the plan is actually with your service provider. And service providers have these cool little documents that they call SOC 1 reports. And those describe the internal controls of the service provider. They also have been tested for effectiveness. They have the exceptions to any of those tests that are detailed on the document or on the SOC 1, which is great. All that kind of stuff is great for auditors because what we can do is we can read those and we can read those and then we can leverage those controls that have been tested into our audit so that we don't have to do as much testing and we also get a great leverage of understanding the controls about the plan. If you're using a service provider, you should absolutely be getting a copy annually of the SOC 1 report and reading it. I don't recommend reading the whole thing. But definitely looking through kind of the key controls that are being applied to your plan. Right. Any exceptions that they had during the year, those are the big things to kind of look at. Right. And just being aware of that these things are happening. The biggest thing being that you have a fiduciary responsibility to monitor any of your service providers that you elect to use. So if you're not actually looking at this SOC 1, there might be some good information about like a massive exception that happened during the year that affected all of our plans, and you're not even aware of it because we didn't even ask for a SOC 1 or know that it existed. So that's number one, is definitely get a copy of this and kind of thumb through it and look for red flags and that sort of thing.
Actually, good questions come up, which kind of goes with this. Because I'm going to forward the slides because next you're going to cover kind of it's coming up. But one of the questions is like, it's back to about deferrals, but it's really about this as well. That, we have our third-party administrator handles our deferral wires, right? Maybe like our payroll provider goes in and grabs our deferrals. So we outsource, and how do we know it's on time? And here's rule number 2, right? The first one was your plan document rules. Here's my advice or rule number 2 for you all who have not been audited. You are the fiduciary. The buck stops with you. You cannot and will not have the option to go in front of the DOL and say, my record keeper does my eligibility. Everything's outsourced. My payroll person goes in. I didn't know it was late. I didn't know it was inaccurate. No one will care. So this is why internal controls become super, super important.
Absolutely.
Because internal controls helps you monitor your providers. It's okay to outsource, but you have to monitor. So how do you monitor? This is the process that Brian is going to go over now.
Absolutely,
is you have to monitor because you're it. And I cannot stress that enough because so many times I've been in these situations and the client's not aware because they don't have controls and things are super, super screwed up and you have to correct them.
Yes.
So
So the biggest thing is that, the service provider will do what you tell them to do. Generally, they do a pretty good job at it, right?
Mm-hmm.
So the biggest things to monitor is information going to your provider, information coming back from the provider, and then reviewing the reporting that they give you to make sure that they didn't process something inaccurately or there's some funny business going on that you missed because we didn't review the reporting. So number one, they're going to process all of their participant level transactions based on the data that you give them.
Right.
So if you tell them that a participant is terminated, then they're going to allow them to take a distribution.
Yep.
If you tell them that a participant's over 50 years old, they're going to let them take catch-up or make catch-up contributions. Mm-hmm. If they're over 70 and a half and they don't work for the company anymore, they're going to start kicking them out through minimum required distributions.
Yep.
So there's a lot of things that go out based on that data that you give them through census reports or however that's communicated. Mm-hmm. And that's very important that the data that's being given to them is accurate. And I have a lot of companies that say, yes, I manually go in and I type in new hires and nobody looks at what I have ever done.
Yep.
And nobody reviews the reporting or anything like that because I'm just one person. And it can only do so much. Now, that person's supervisor or the CFO or whoever should, I'd say, every once in a while go and check the work that they've done. Maybe not every time, but at least every quarter, compare payroll reports to actual census files from the provider, see if everything got entered in correctly. Because if it's incorrect, things go wrong.
And that's our number 2. It's coming back to you. Review it. Have your provider give you talk to them. Go, can I look at the distribution list?
Yep.
Is it accurate? Can I take the loan? You might notice an employee on the loans that's terminated.
Sure.
If something happened, we've seen this, and they took a loan out. And it's like, well, I think that person, we just had their exit interview.
Yep.
So review.
Yep.
And that's the best
thing. The termination distribution to the 20-year-old kid who's still working for the company. That's not good. There's no reason that person should be able to take a distribution other than maybe a hardship. So it might not be. So review the reporting, review the information that's coming in from your TPA that's like deferral changes, those sort of things. Make sure it's syncing with payroll. Have a control for it. Have more than one person looking at it.
And then I don't know what you want to cover on financial reporting so we can do the last polling as well.
Yeah.
Do you want me to move it?
Yeah, I'm moving into this one, but from here on out, could you do that? Yeah, that'd be good. Okay, so the biggest, and this is for all my CFOs and the accountants, controllers in the room. We're getting back to accounting. The biggest accounting provisions that you should know about as you're reviewing financial statements. Number one, fair value, ASC 820 all the way. I've learned more about ASC 820 through doing plan audits than I ever care to know. So we're talking about fair value. Basically, people taking responsibility for financial statements should have a really basic knowledge of what the standard requires from a measurement and disclosure standpoint. If you have any questions and you're a Moss Adams, even if you're not a Moss Adams client, you can call me anytime. I'll walk you through it. Anything you need to know. Mm-hmm. And understanding how each investment is valued in the plan and presented on the fair value table. Now, a lot of people just kind of say they're all mutual funds. It's all level 1. Very easy, right? But if you have any if you're with an insurance company, a Prudential, a Principal, or Transamerica, those things that look like mutual funds are probably not actually mutual funds. And that's a very big misconception throughout the industry, is that a lot of investment companies use names that will confuse you and don't really tell you what the investments actually are and how they should be presented. It's an interesting issue that we've been kind of battling for a long time. Be very clued into what you actually hold and how it's valued. And pay close attention to non-mutual fund investments like common collective trusts or, like I said, insurance company products. The fair value reporting for disclosure requirements are more involved than for mutual funds alone.
And so on the next slide, I think you're covering a little more of like
stable value.
But I think I'm gonna
Okay.
If we can kind of, because these are, if you have them, we're just saying that there's just complex structures and there's a lot of disclosures. So they'll have access to the slides.
Absolutely.
If you have these, please ask us, because we want to get to the last polling. And we have a best practices as well. And I'm bringing that slide up of what, I pushed it to the poll. But one thing before the poll is open is the limited and full scope audit. I realize that we don't really cover it here, but if the plan is custodian is a trust, bank, or insurance company, we could do a limited scope whereby we don't audit the investments and related earnings. And I'm just mentioning that so that especially the finance folks on the call know that there is two types of opinions that are issued on these audits, and the custodian makes a difference. So when you're going through your first audit, the auditor or someone will ask, what kind of audit can we do? That's limited or full depending on your custodian. So again, ask us if you have questions, but that's kind of where that comes from.
Yeah, and just because we don't audit the investments doesn't mean that we don't care about things like fair value reporting. We actually we still have to nail the fair value presentation, even though we're not auditing things like fair value we're not actually determining that the fair value is accurate. We are making sure that the fair value presentation is accurate. So it's a really weird kind of distinction there.
So you're seeing the polling, it says out of the 5 preparation areas, which do you think your company is prepared for? And if you're good, you might be prepared in all areas, which is awesome. So I'll did you advance already? I don't know if your advance is working. Your thing is red. I think actually your mouse might not be working, but I'm going to advance. Here we go. Oh, wow. Okay. So document gathering and organization wins, I guess.
Everybody seems to be 42%.
Yeah, that's awesome that you're well prepared. So that is just awesome. And I think this is where our prepared remarks end. And we've covered most of the Q&A. We've tried to answer a lot of the questions. If you have anything else that comes up, please email us. And if you want any grids or anything. And I think Emily needs a few more minutes to cover some last-minute housekeeping items.
Yep. All right. Thank you, Ryan and Bertha, for a great presentation. We had some great questions come in, and as Bertha mentioned, if you have any more questions, feel free to send either Ryan or Bertha an email. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE Progress window. Click the icon to download a PDF copy of your certificate. And I'll be keeping the webcast console open for a few minutes to give you time to download your certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. And here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.